Hi, everyone. Thank you all for joining us for Creative Strategies for 1031 Exchange Properties. Today, our presenter is Theresa Knower. She is the Vice President of Midland 1031. She's been with Midland for 15 years, and she is a CISP and also a CES, a Certified Exchange Specialist. If you do have any questions, feel free to type them into the chat box or the questions tab on the screen. And we will answer them after the presentation. All right, Theresa, take it away.
All right. Well, good afternoon, everyone. Brenda, thank you for the introduction because it saves me from having to do that awkward thing where I have to talk about myself, which I hate. So thank you all for joining us today. As Brenda mentioned, my name is Theresa Knower. I am speaking to you guys from our beautiful office in downtown Chicago. It is about 30 degrees, snowing outside, and so I'm very thankful to be inside spending the afternoon with you all. As Brenda mentioned, today we're going to be talking about creative strategies for 1031 exchange properties, and hopefully we'll give you some ideas that you could possibly implement or perhaps your clients could. A little bit about Midland. We are self-directed IRA administrators, and we are a qualified intermediary for 1031 exchanges, which is the subject of today's session. Our main offices are in Chicago and Fort Myers, and our trust company is based in Sioux Falls. A little bit of history about our QI services. We've been acting as a qualified intermediary for 1031 exchanges since 1997. We are proud to have 2 certified exchange specialists on staff. We do pride ourselves on providing personalized service to our clients and partners in this. We are bonded and insured, and while we do not give any legal, tax, or investment advice, our offices are operated by individuals with backgrounds in the legal and tax fields. So our goal today, and with any presentation that we give to you, is to provide education and arm you with some information that you'll hopefully be able to take to your legal, tax, and investment advisors and make informed decisions. So what are we going to do today? Well, we're going to talk about a few things within the tax code as it pertains to 1031. We're going to talk about the vacation home rules. We're going to talk about combining a 1031 exchange with the primary home exclusion. We're going to talk about converting property that you use personally, such as a primary or second home, to an investment property so that it will qualify for a 1031 exchange. We'll talk about going the opposite direction, converting a 1031 exchange property to a personal use property. And we've got a couple of case studies or examples to show you that'll illustrate some of these strategies. Before we dive in, I do want to give everyone a very quick refresher on what a 1031 exchange is and who can take advantage of this strategy. 1031 is a section of the tax code that basically allows a taxpayer selling investment or business use property the opportunity to defer the taxes that would have applied, provided they purchase more investment or business use property of equal or greater value within the established deadlines, and they follow a few simple rules. Okay, so the first rule was already addressed in the definition. They have to be buying and buying investment or business use property. They have to complete the exchange within 180 days of closing on the sale of their current property, also known as the relinquished property. They have to identify their target replacement property within the first 45 days of that 180-day period. They must use a qualified intermediary, which is an independent third party that's there to facilitate the exchange, and that is their sole function. That's the role that we play at Midland. We're the qualified intermediary. We make sure that the exchange is documented properly and that the regulations are followed to the letter as it pertains to 1031. And finally, if somebody wants to complete an exchange and have a fully tax deferred transaction, they're going to need to make sure that they buy property that's of equal or greater value to the property they're selling. Whether they allocate that over perhaps 1, 2, 3 properties, that's entirely up to them. The goal is to match value for value. So if you sell $500,000 worth of property, you want to ultimately buy around $500,000 worth of property, less your standard costs of closing on the sale. So who can take advantage of a 1031 exchange? Anyone. Anyone that's selling investment or business use property. So it can be an individual, a corporation, a trust, whatever is taking title to the property that is investment property or business use property, that's the taxpayer. That is who can complete the exchange. When people are contemplating an exchange, we inevitably encounter some questions about the property that they're going to be selling and or purchasing, and whether or not it would qualify for an exchange. In a perfect world, the property sold and the property purchase would be strictly investment or business use without any sort of deviations, but that is not always the case. So we often get the opportunity to speak with prospective clients who live maybe somewhere up north or here in the Midwest who own a vacation home somewhere like Southwest Florida. They rent it out, but they also use the property personally, and they're not quite sure whether or not it would qualify as an investment property for an exchange. So when they ask, what about a vacation home? Do they qualify? The answer is it depends. So Revenue Procedure 2008-16 gives us some direction on whether or not a property will qualify for Section 1031. This is actually nice because it's for those of you that work with real estate investors that have this type of property, it's a good quick checklist to see if maybe or not they would be a good candidate for an exchange. So the first question that we'll ask a prospective client is, have you owned the relinquished property for at least 24 months immediately prior to the exchange? The next question is, within each of the two 12-month periods prior to the sale/exchange, have you rented the property to an unrelated third party at fair market rental rates for at least 14 days or more? Finally, has your personal use of the property, does it exceed the greater of 14 days or 10% of the number of days that the property is rented out? So I will tell you that the ownership period is usually not an issue. Even the rental period is usually not an issue. Where clients run into hurdles is with respect to the personal use. It's very clear that if they use the property for more than what they are allowed, which is the greater of 14 days or 10% of the number of days that the property is rented out, it's not going to work for the exchange. I do want to also point out too, I'm going to show you an example here in just a second, but I also want to go back to the first point. I purposely put in there that the taxpayer has to rent the property to an unrelated third party. Reason being, related parties are considered basically the same as the taxpayer in terms of personal use. So the only way that a taxpayer could rent to a related party and not have it be considered personal use on the part of the taxpayer is if that related party were renting the property as their primary residence and renting it on an annual basis. But at that point, it no longer is a vacation home for the taxpayer. But I do want to mention this because sometimes clients will ask, well, can I rent it to some family members? Does that count towards my rental period? No, it's got to be an unrelated third party. Same thing with personal use. Personal use extends to use by anyone that's considered a related party to the taxpayer. So if you've got family members that are using the property when it's not being rented, then that technically counts as personal use on your part. Prior to Revenue Procedure 2008-16, it was really left up to the interpretation of the taxpayer and their tax advisors to determine whether or not they felt a property would fall under the umbrella of an investment property. So, for example, people that rented the property out for 5 months in a given year, but used it for 3 months in the same year, technically could have elected to attempt an exchange on the property prior to this revenue procedure. Now we have very clear guidelines that eliminate those gray areas. It's very clear what'll qualify, and anything that falls outside of these criteria are not going to qualify for an exchange. So here's an example. John and Mary Smith own a condo on Fort Myers Beach. They're getting ready to sell, and they want to know if it'll qualify for a 1031 exchange. So we run through the questions. Have you owned it for at least 24 months? Yes, they've owned it for 7 years. Have you rented it at fair market rates to an unrelated party at least 14 days each year? They confirm it's been rented 200 days each year. Perfect. Now, what about your personal use? They use it 17 days in each 12-month period during the last 24 months. Based on this information, this property would be good for an exchange because their personal use did not exceed the greater of 14 days or 10% of the total number of days that they rented it out in a given year. They technically could have used it 20 days in a given year, but they used it 17, so they're good to go. Now, had they used the property for 30 days in a 12-month period, now we would have a problem. So again, it's nice to have these guidelines. You may have clients that, are considering doing an exchange on a vacation property, or maybe you have your own vacation rental and you want the opportunity to do an exchange. Keep these personal use restrictions in mind, because that is typically what will create an obstacle to getting an exchange completed, is usually the personal use. Okay, so now, what if the property was at one point a primary residence and it was investment property? Can you take advantage of 1031 and the primary home exclusion? Because technically it was both during a period of time. Yes, you can combine it. But first, before we talk about how that would work, let me just briefly touch on Section 121. It allows a taxpayer to exclude up to $250,000 or $500,000 if married of gain realized on the sale of a primary residence if it was owned and used as the taxpayer's primary residence for at least 2 years during the 5-year period prior to the sale. And when I say 2 years, it's 24 months. So technically, it's a total of 24 months during a 5-year period. So it doesn't have to be 2 consecutive years. It just, at the end of the 5-year period, you will want to make sure that you have 24 months as your primary residence. So now we're going to talk about how to combine the two. So under Revenue Procedure 2005-14, a taxpayer has the opportunity to exclude the capital gains under Section 121 and defer capital gains in an exchange under Section 1031. So there's a couple of rules. First, as we mentioned earlier, in order to do an exchange, you have to make sure that the property that is being sold and ultimately acquired has to be investment or business use property. So the property's last use must have been as investment in order to qualify for 1031 in this particular scenario. Now going to the rules of Section 121, they also must have occupied the property for 2 out of the last 5 years as a principal residence. Okay, so to qualify for 1031, its last use has to have been as investment. And then also on top of that, in order to qualify for the primary home exclusion, they have to have occupied the property 2 out of the last 5 years. Okay, so By taking advantage of Section 121, they can now take up to $250,000 or $500,000 of gain tax-free under Section 121. Exchange the rest of that value into like-kind business or investment property for equal or greater value. And now you defer the taxes on that portion of the transaction. So let's look at an example. Tony and Nancy bought a property as a primary residence in 1997 for $200,000. They converted the property to a rental in 2018 and then sold the property in 2020 for $860,000. So if they only applied Section 121, then at the end of the day, when you look at sales price of $860,000, let's just say for illustration purposes, closing costs were $60,000. The maximum that they could exclude under Section 121 is $500,000. They bought the property for $200,000. That would still leave them with taxable gain of approximately $100,000. However, because the property was a rental property at the time of the sale or investment property, they have the opportunity to combine 1031 and Section 121. So now here's what the transaction looks like. Again, still the same facts. They're selling for $860,000, closing cost of $60,000. Right off the top, they get to exclude the $500,000 because of this personal or primary home exclusion. That leaves $500,000 to put into a 1031 exchange and defer the taxes on that. So at closing, they get to put $500,000 tax-free cash in their pocket and then complete an exchange on the remaining $300,000. If they purchase another property of $300,000, or maybe they want to buy two smaller properties totaling $300,000 within the 180-day exchange period, now they defer the taxes on that $300,000 as well. So something to think about. Again, if you're in that situation or you have clients in that situation where maybe you've got rental property right now, but in the last 5 years it was also occupied as a primary residence, if you're considering selling, there's some options here for you. Now, what about, okay, so we talked about a property that was first primary residence and then converted to an investment property. So you were able to take advantage of Section 121 and 1031. What about mixed use property? And when I say mixed use, I'm talking about the property that you're selling consists of your primary residence and maybe there's a separate guest house that you rent out, right? So part of it is your primary home and part of it is technically investment property. You can do an exchange on the guest house portion of the sale and claim your Section 121 exclusion on the primary residence sale. What about if the property that you are selling consists of your primary residence and a portion of the same dwelling is used as your office? Can you still utilize both? Short answer is yes. The longer answer is that the exchanger will need to be sure to consult with their CPA for the allocation amount, because you're going to ultimately need to know what percentage of the total square footage is allocated to primary residence versus what percentage of the square footage is allocated to investment property. And obviously only what's allocated to investment property would be put into the 1031 exchange. And then when it comes time to go to closing, there would be a line item referencing proceeds on behalf of the sale of the investment portion, and then the balance would represent the proceeds from the sale of the primary residence. So it is possible to do that. It would take a little bit of additional legwork to make sure you get the proper allocations done well in advance of closing so that everything can be documented properly, but it can be done. And quite often, especially now, people are working out of their homes, and if you have a designated area that's your office, then there's an opportunity there as well if you're going to be selling that property. So sometimes people will come to us and we'll talk about the vacation home rules and what the personal use restrictions are. And they'll say, well, gosh, we don't really meet the criteria. I've used the property too much. So what does that mean? Well, the good news is you still have options, but the potentially bad news is you're going to have to minimize that personal use to fall within the allowable limits. And again, Revenue Procedure 2008-16 is really going to be your guide. And then rent the property out to someone if you haven't been renting it out. So time is going to have to be on your side in this situation. It's because it'll require that you rent it out and pull back on that personal use, and that may or may not be an option. If you're under contract to sell today, then you don't have the option to minimize that personal use and try and up the rental activity. But if this is something that you're considering down the road and you want to make sure that the property will qualify for an exchange, then go back to the RevProc 2008-16 requirements and make sure that you keep your personal use within the allowable limits. And if you can do that, then it doesn't matter if it's a second home today and that's all you use it as. You can convert it to a property that will qualify as an exchange property. And it really comes down to the personal use. What if you want to move into your 1031 property? So we get people who ask this question quite a bit. And what I'll tell them is this, you can, not right away. So you can have all you want, everything that you want. You can defer the taxes in the exchange, and you can ultimately make this property your personal residence, but you can't have it all at once. So at the time of completing the exchange, the intent is going to be very, very important, both at the time of the sale and when you acquire the new replacement property. The intention has to be to hold the new property as investment or business use property. The way that you prove your intent is demonstrated by how long you hold the property, number one, and how you treat the property. Are you renting it out? Are you generating income off of it? The burden is ultimately on the taxpayer to prove the intention. So if you can master those two, if you can hold it for a period of time, typically most tax advisors would suggest at least 1 to 2 years before contemplating another exchange. If your objective is to move into the property, then most tax advisors tell their clients to treat the property as investment for at least 2 years and then start thinking about moving into it. So if the goal is to move into it right away, that's not going to work for the exchange because now we do not have LikeKind properties. Remember what we mentioned earlier was that exchange properties that are sold and purchased have to be investment or business use. If you sell investment or business use property with the intention of buying your primary residence that you're going to move into immediately, that is not a LikeKind exchange. But you can buy another investment property with the goal of eventually moving into it after the appropriate amount of time. So it's all about kind of taking a step back, knowing what the rules are and how to maneuver them and plan for the future. So the more that we can find out from a client when we're talking to them, if they say, well, but I want to buy my primary residence. Like I was planning on moving into it right away or using it as my second home. We'll usually try to discuss some alternatives, such as, well, okay, do you absolutely have to do that? Can you rent it out for a little bit? Because then that will afford you the opportunity to complete this exchange. If it's not, then the discussion is pretty much done in terms of whether or not you can do the exchange. So we try to come up with alternatives, and it's really helpful when clients ask these kinds of questions because it helps us to give them options that they can consider and discuss with their tax advisors and figure out what the best move is for them. So one thing that people will sometimes get confused on is when they hear the phrase like-kind exchange. So it's a lot of times it's called a tax-free or tax-deferred like-kind exchange. And they think that that means they have to buy the same type of property as what they're selling. So if they're selling an apartment building, they think that they have to buy another apartment building in order to make the exchange work. And that is absolutely not true. As long as the properties that are being sold and purchased are investment or business use, all real estate is considered like-kind to all other real estate. So you could sell some raw land that you've had and exchange that for either residential or commercial property that you want to generate some income off of. You could sell residential property and reinvest into commercial property if you wanted to. It comes down to how you treat the property. That's what we talk about when we are referring to like-kind. Other than that, the sky's the limit. You can, like I mentioned earlier, you can allocate the value over several smaller properties if you wanted to, or if you wanted to sell multiple relinquished properties and consolidate into one larger property, that's an opportunity for you as well. That can get a little tricky with respect to the deadlines, but it's certainly an option that's available to taxpayers, and one that we've seen clients employ many times because they want to simplify. They want to, maybe they have properties in various states and they're trying to just downsize or simplify things without taking a tax hit. And so what they'll do is they'll sell those properties off, pool the funds into one larger property that's a little bit easier for them to manage. So that's certainly an opportunity for them. There's a lot of options available to taxpayers if they just ask questions, and don't be afraid to throw out whatever scenario you're thinking of, because we can usually figure out an alternative, or at least offer an alternative to discuss with your tax advisor and see if it works. There's very, very few scenarios where there isn't an alternative solution that someone could look into. And again, it goes back to, you can have everything that you want, you just can't have it all at once. And so if you're doing an exchange, what you get right now is the benefit of deferring those taxes. If you eventually want to move into the property, you can do that, but you're going to have to be patient and you're going to have to wait for an appropriate amount of time. Those are just a few of the strategies that we wanted to share with you all, because there are questions that come up quite often when we are talking either with prospective clients or perhaps their advisors, and they just kind of want to know what's allowed and what isn't and what options are available to them. I would encourage you, if you have any questions or anything that you want to discuss, you are always welcome to reach out to me or any member of the 1031 team to discuss it further. We really try to provide as much information as possible and help you make those informed decisions. And so our consultations are free, so you call us anytime. You can ask us any questions. And if we don't know the answer, we'll tell you that too. And we'll try and do our best to do a little bit of research and get you the information that you need. But we'd rather people know what their options are, know what the requirements of the exchange are before going into it, so that they go into it with their eyes open and we don't have any missteps along the way. And with that, I will hand it back over to Brenda. If we have any questions that we need to tackle, I'd be happy to.
We do have a couple questions here.
Okay.
Great job, Teresa.
Thank you.
Okay, so are the rules the same for 1031 exchanges and IRA purchases?
Oh, good question. No. So, so I'm guessing whoever asked this question is familiar with the IRA process. So when somebody's doing a straight 1031 purchase, we don't sign any documents other than a copy of the closing statement. And the buyer on the deed and closing documents is going to be the taxpayers themselves. So there is 1031 verbiage on the closing settlement statement, but that is the only document that will reference a 1031 exchange. Everything else is going to be directly in the taxpayer name. The client is going to sign everything just like they would in a normal transaction. So the processing of a 1031 exchange transaction is different from the IRA in that respect. However, we do require that our clients give us approval on the documents that they receive and authorize the release of the funds for closing. But it is definitely different from processing IRA transactions.
Okay, great. What is the minimum profit threshold where a 1031 exchange makes sense? Not sure the total administration cost to do a 1031.
So the rule of thumb is, so I think what they're asking is if maybe they're buying less in value. There's not so much a minimum. Well, I don't want to
Well,
say minimum
someone else
profit.
had a similar question. At what amount of profit does it make sense to do a 1031? I feel like it's the same one.
So there's no like specific dollar amount in terms of profit. It's more when does an exchange not make sense? Because profit is profit. And so if you don't want to pay taxes on that, then it would make sense to do the exchange. But there are times where people want to buy down in value. So let's say they sell for 500,000, but they only want to buy a property that's 250,000. Well, that's not going to work. Maybe not. I shouldn't say it's not going to work. Depends on how much gain we're talking about and what the basis is in the relinquished property. The rule of thumb is if you're buying replacement property that's at least equal to or greater than the basis of the relinquished property, then there probably is going to be some benefit to doing the exchange. The long and short of it is, if you're not sure whether or not the exchange makes sense, you really need to talk to your tax advisor just to get a rough idea of what the tax liability would be if you were to forego and just sell outright. Because you may have some losses elsewhere that would offset some, if not all, of the gain that you're going to be looking at in this transaction. I do want to clarify, though, in order to have a fully tax-deferred exchange, you are not rolling over just the profit into the new property. It has to be the equity as well. So keep that in mind, because sometimes people think they only have to roll the profit into the new property, and it's value for value, not profit.
Okay, great. I did include in the chat box right now a link to our capital gains calculator. So if you just want to get like a rough estimate on what your capital gains might be, we have a calculator to do that on our website.
Thank you.
All right, and then we have another question here. So IRA/401k profit is just added into account and taxed at taxpayer rate once the distribution is taken. Is deferred within account? Question mark. So yes, if you have a property inside your IRA account, all of the rental income and the sale proceeds, they are all tax deferred while they're inside the account. You do not get taxed on that until you take it out as a distribution. I think that answered their question.
Okay.
Is
So that was an
Dennis?
IRA. Okay.
I think that's what he was asking, but he's typing still. So,
Okay.
oh, that's what he thought. Okay, cool. All right. Does anyone else have any other questions for Theresa while we have her on here? I am going to send this out to everybody, the recording, as well as Theresa's contact information. So if you do have any more questions, you can reach out to her directly. Let's see, one person typing. Oh, much appreciated. Okay, great. Well, it doesn't look like you have any more questions. So Theresa, thank you so much. You're awesome. And like I said, I will send out her contact information afterwards.
All right. Well, thanks everyone for joining us today. I appreciate your time.
Yes, thank you all for coming. Have a nice day.